Morning, Vitale Wealth Management here with this week's Gradient Investment Market Update. All information is gathered as of the week of March 23rd, 2026. Hope everything's going great so far. Let's get into the weekend review. It was the fourth consecutive weekly decline for U.S. equity markets. The Dow Jones led the decline once again, falling 2.09%, followed by the NASDAQ by 2.06%. The S&P 500 was down 187. International markets also faced pressure, with emerging markets down 0.33 and developed markets falling 2.05%. Now, sector performance continues to diverge. Energy remains the standout performer year to date at 32.8%, while financial lags down 10.4%. Now, overall, the S&P 500 is down 4.6% so far in 2026. Fixed income, the yield on the 10-year Treasury rose for the third consecutive week to 4.39, its highest level in 8 months, putting downward pressure on bond prices. Gold was down nearly 10%, marking its third straight weekly loss. This move reflects reduced expectations for near-term interest rate cuts, a stronger U.S. dollar, and profit-taking activity, which have outweighed gold's traditional safe haven appeal despite ongoing geopolitical tensions. How about upcoming economic releases? The calendar is relatively light this week, with a few reports offering insight into global trade and consumer confidence. On Wednesday, the U.S. import and export prices will be released, providing a read on global trade dynamics. We'll talk about that next week. Also on Friday, the University of Michigan Consumer Sentiment Index will offer an update on how the U.S. consumers are feeling about the current economic environment. And of course, a lot of people aren't feeling too good, but hopefully things are going to start easing up, and we'll get some clarity on what's happening in the Straits and with Iran and everything. The Federal Reserve left interest rates unchanged last week, in line with expectations. Market attention centered on Chair Powell's comments on persistent inflationary pressures and heightened uncertainty of energy prices amid the ongoing conflict in Iran. Powell emphasized that the economic implications of the conflict for the U.S. remain uncertain at this stage. Globally, the U.S. major banks, including the European Central Bank, and Bank of England, Bank of Japan, and Swiss National Bank, also held interest rates steady as they navigate renewed inflation risk tied to rising energy prices, which of course I believe is going to be short term, and hopefully we will see that. Oil prices showed signs of stabilization last week following prior volatility. Crude oil settled in at $99 a barrel. On Friday, slightly up from $98 the previous week. It remains well above its recent February low of $65. Year to date, oil prices are up 74%. Looking ahead, markets' focus will remain firmly on developments in the Middle East, particularly the Straits of Hormuz, a critical choke point for global energy supply, and continues to drive volatility in the oil markets. So that's, even though we've got plenty here, it's still the international is what it's looking at. Recent activity in the gradient investments, as you know, we kind of rebalance other portfolios as need be, but there has been no rebalancing. We don't need to. We'll check it again in a couple weeks. Stocks in the news: Lululemon, which is owned in the G33, beat earnings on top and bottom lines, but gave weaker than expected forecasts as it navigates tariff headwinds and proxy flight with its founder, Chip Wilson. But shares were up 1.82% for the week. How about Alibaba, which is owned in the G40I? Disappointed on revenue, reported a sharp 66% decline in net income, driven by elevated investments in e-commerce, user experience, and technology initiatives. Shares were down 10.46% for the week. So you see that last year we saw, international, everything was good last year, the S&P. This year we're getting not really a correction, it's getting close to that, but everything was going very well. Now we've got the pullback because of what's happening in Iran. Hopefully, we've seen in the last couple days, the market has rallied because, it looks like we're going to be getting a deal over there. Hopefully that happened. But remember, with all the tariffs that happened last year and Trump getting the deals, things have been lightened up, and that's why everything's going to keep going. But we're going to have the turmoil, and we're going to have the volatility. The VIX index, the volatility index is crazy right now. So yes, we're having ups and downs, but this is a time where we keep our heads, we stay the course, we have proper allocation everywhere, and so we can weather the storm or weather all the uncertainty. But I do believe we're going to start to see things turn around and get pretty good this year. Hopefully, we're still going to see a couple rate cuts this year. 2 to 3, I think we're going to see by the end of the year, especially if we get a new Fed chair in there, which is definitely going to help things. But that's it. If you need to get a hold of me, give me a call, 855-756-5700, or visit us at vitalewealth.com. God bless you. We'll see you again next week.